Good afternoon, everyone, and welcome to Keiter's first live webinar devoted to the recently enacted CARES Act. We will first want to thank you for taking your time this afternoon and trusting us to be your advisor in this process. We hope that you find this time to be useful and well spent. This webinar will be the first of several webinars that Keiter has dedicated to unpacking the content of the recent legislation and discussing how it may impact you as a small or medium-sized business owner. We understand that we're really in uncertain times right now. Business leaders and business owners are faced with making decisions surrounding unprecedented circumstances. So today's presentation is focusing on just one provision of the CARES Act that's designed to provide liquidity to businesses in those uncertain times. So throughout the presentation, you'll have the option to ask us questions through the chat feature that's located here. A couple of things to note about that. First is that your questions will be posted anonymously, so only Matt and myself will be able to see those questions. But please include your name when you ask those questions so that we can follow up with you and your company after the fact if we aren't able to get around to it. We only have 45 minutes today, so we're going to try to answer as many questions as we can, but we're going to prioritize those questions that have the broadest application and then try and follow up on those that are a little more specific in nature. Second, and importantly, we want to caveat that this presentation is made with the best information that we have available right now. But as you'll learn, there are several ambiguous items that are still in the bill that we're seeking clarification on. And so to that end, we'll keep you informed as we get that information and as those changes are happening. But know that this is not necessarily the final version. So with that, I'd like to introduce Matt Austin, a colleague of mine, to introduce the team.
Thanks, Scott, and thank you everyone for taking some time out of your day to spend with us. Just a brief note on Keiter Advisors, which is the advisory arm of Keiter. As a group, we provide mergers and acquisitions advisory, due diligence services, quality of earnings services, and consulting for small and medium-sized businesses. Our team, which you can see on the screen, has varied backgrounds from tax CPAs to private equity, banking, and operating company roles. We find the breadth of this experience helpful in times such as these. We encourage any of you to please reach out to any member of our team or the Keiter CPA team member with questions, or let us know how we can be helpful to you in these uncertain times. Also, continue to reach out to your lender and attorney as more details about the program that we'll discuss become available. Next slide. Okay, so today we'll be talking about the CARES Act, primarily the Paycheck Protection Program, which is a section of the CARES Act, and that details certain loans that are available to qualifying concerns. The act was signed into law by the President on March 27th. Please note that while the act provides detail, there are many aspects of the bill which will be clarified and further defined in the coming days and weeks, as Scott suggested. This additional guidance and program documentation will come from the SBA and participating lenders. Keep this in mind as we walk through the concepts and our understanding of the Act today. So the total amount appropriated for the program is $349 billion and allows for loans in size of up to $10 million. We'll get into the specifics of how you calculate loan size a bit later. Note that eligible borrowers can apply through June 30th, 2020, when the program is scheduled to end. Loans will be processed and approved by those lenders who are eligible to make SBA 7A loans. The Act does give the SBA and the Secretary of the Treasury to make other lenders eligible if they deem appropriate. A unique aspect of paycheck protection loans is that if these loans are used for specific expenses and the borrower maintains a certain level of employees and salaries, the loans are forgiven. We'll talk more about this later in the presentation. I'll kick it back to Scott.
So the first question that all of us should be asking ourselves is, who's even eligible to participate in a program like this? And so the SBA has guidelines around that, or the Act rather has guidelines around that. The first is that a borrower has to self-certify that, or make a good faith certification that the uncertain current economic conditions make it necessary that the loan request be made to support the ongoing operations, and that you acknowledge that you'll use these funds to retain workers and maintain payroll or pay these other certain expenses that we'll talk about. And so we feel like this is an ambiguous and broad good faith certification that a majority of our clients will be able to certify, given that they are in fact uncertain about the current economic conditions as a result of the coronavirus. Second is that the SBA lays forth or sets forth guidelines for size. You'll note that there isn't a revenue threshold that we talk about. We're going to be talking about specifically employees, and as it relates to employees, we're not talking about just full-time employees. So we're talking about full-time, part-time, and even independent contractors that might be under your control. So we'll talk a little bit more about that later. But in general, businesses with fewer than 500 employees will qualify for this. It's important to note that the SBA has a guide that's an industry-specific guide that goes down by NAICS code and will actually set thresholds for different industries that might exceed 500. So to the extent that a tire distributor code has an SBA minimum that's greater than 500, you get to look to that code. So if you find that your business is a little bit greater than 500, it's worth exploring that code. I believe they go at least up to 1,250 in certain industries. So definitely look at your NAICS code and look at the SBA guide to see if you would qualify. A couple of other interesting things about the eligibility is that nonprofits with fewer than 500 employees and veterans organizations with fewer than 500 employees will also qualify for this. So it's not just for-profit enterprises. Sole proprietors, independent contractors, and self-employed individuals will qualify. And it's also important to note that there are special provisions and exceptions related to accommodation and food service businesses. So the easiest rule of thumb around this is if your NAICS code starts with 72, then you can have your own affiliation rules, and also it looks at more on a per location basis to see if you exceed 500 rather than an enterprise level. So if you are in the NAICS code 72 and you exceed 500 employees, reach out to someone familiar with the rules, because there may be an exception for you in that.
Got it. Thanks, Scott. So one question you might have is, how do I determine what loan amount I'm eligible for? So the first thing is, in determining that amount, we believe most borrowers will fall under the first bullet, which basically says the loan amount that you're eligible for shall be 2.5 times the average total monthly payments the borrower made for payroll cost, and we'll define that in a second, during the 1-year period before the date in which the act says is made. We suspect that might be redefined to applied, but basically it's 2.5 times your average total monthly payroll cost the 1-year period prior to the loan date. We feel most folks on this call will fall under that bucket. There are different periods used for seasonal businesses and for businesses that were not in operation between Feb 15th and June 30th of 2019. For seasonal businesses, you can see that's the second bullet point. It's 2.5 times either the average monthly payroll cost for the 12-week period beginning Feb 15th, 2019, or the period between March 1st, 2019 and June 30th, 2019. For those businesses that were not in operation between Feb 15th and June 30th of last year, then it's 2.5 times the average monthly payroll cost from January 1st to February 29th of this year. As we stated before, the loan amount cannot exceed $10 million. So with that, let's flip over and talk about what defines payroll costs, because it's an important definition throughout the payroll protection program. So how are payroll costs defined? And it's somewhat of an exhaustive list, but we'll summarize. Salary, wages, commissions, or similar comp, payments of cash tips or equivalents, vacation, parental, family, medical, and sick leave, allowance for dismissal or separation, payments required for the provisions of group health benefits, including the employer portion of the insurance premium, payments for any retirement benefits, state and local taxes assessed on the compensation of employees, so basically state and local payroll tax. And then a little tricky one, which is sum of payments of any compensation to or income of a sole proprietor or an independent contractor that is a wage, commission, income, net earnings from self-employment or similar compensation and is not more than $100,000 in 1 year. It's important also to know, so that's what payroll costs are defined as. I know that's a laundry list, but you can see they're pretty much captured in the first bullet point. Just as important is what is not included in payroll costs. And fortunately, it's not as long of a list. The first one is compensation of an individual employee that's in excess of an annual salary of $100,000. We'll talk more about that later. Federal payroll taxes, compensation for any employees whose principal place of residence is outside the U.S. And then more importantly, some of you may be familiar with the FFCRA, qualified sick leave and qualified family leave under the FFCRA is not included in payroll costs. So with that, I'll kick it back over to Scott.
So once you have the loan that's been quantified by using the metrics that Matt was talking about, there's then a question about what are allowable uses of these loan proceeds, and why do I care about what these allowable use of loan proceeds are? So allowable uses of the loan proceeds are the payroll costs, which follow the same definition that Matt talked about on the previous slide. They also include the costs related to the continuation of group health care benefits during the period of paid sick, medical, and family leave, interest on mortgage obligations, but without prepayment of that interest, rent, utilities, and utilities being pretty broadly defined to specifically include things like internet, obviously water, sewer, trash, telephone, and interest on debt obligations that were incurred prior to Feb 15 of 2020. One key thing about a lot of these like rent, utilities, and interest is the fact that there's a lot of reference to these services being under a contract or having already started prior to February 15th, 2020. So if you think about utilities and stuff like that, you already have your services set up. That should be fine. But to the extent you're trying to use these loan proceeds to pay something that might appear to be an allowable use, but it's a new contract, you should pay special attention to that. And the reason why we care so much about the allowable uses of loan proceeds are that provided you spend the amount that you borrowed, at least that amount on these allowable uses in the 8-week period after the loan, and you meet these subsequent employee retention and salary retention metrics that we'll talk about, then the loan can be forgiven. Also important is that the loan is non-recourse provided that the borrower uses the funds for allowable uses. The document, the act, will talk about the fact that it has the potential to become a recourse note to the extent they use the proceeds for things that are not allowable uses. And hypothetically, we could think about like borrowing the money and making a dividend recap or something like that. So some lawyers are talking about whether or not it actually could be a recourse note, but all you need to know is that if you use the loan only for allowable uses, even if you don't meet the employee retention metrics, but you only use those proceeds to pay these expenses, the loan will be non-recourse for you.
Thanks, Scott. And as Scott said, to have the Paycheck Program loan forgiven, the borrower must use the loan for the allowable uses and conduct, as we see it, 2 primary tests, which we're going to step through first, and then we'll get to examples of how we interpret those tests a little bit later on. So with that, let's go to the next slide. And the first test that's in the act is a number of employees test. And as I mentioned, we're going to go through an example in a bit of how we calculated this test with a simple example, which will hopefully help everyone on the webinar. But conceptually, it's if the average full-time equivalent employees during the period the loan is outstanding. is less than the average number of full-time equivalent employees in either the period from February 15th through June 30th, 2019, or Jan 1st through February 29th of 2020, then the loan forgiveness amount is reduced by a calculated percentage. So basically, if your full-time equivalent employees goes down relative to either one of those two periods, which the borrower can select, the amount of forgiveness will drop. And we'll illustrate an example to help you grasp it as we understand it. So the number of employees is the first test. The second test is a salary test. And again, we'll have an example a little bit later on for you. But essentially, the borrower is going to compare the salaries of its employees in the quarter immediately prior to the loan origination date. It's going to compare those salaries to the salaries of the same employees during the period the loan is outstanding, which is that 8-week period. If the salary amounts have decreased by more than 25% for any employee, then the amount of forgiveness is reduced. And again, we'll go through an example. There is one important note on the salary test, and the Act says the only employees considered for the salary test are those who did not receive during any pay period in 2019 wages or salaries at an annualized rate of pay in an amount of more than $100,000. So that's an important description of eligible employees for the salary test. And with that, I'll kick it back over to Scott.
So a lot of small businesses had to make quick decisions as our current situation unfolded, such that we had to furlough employees, lay off employees, cut hours, whatever the case may be. And so a lot of people may have a question, well, did I do something in the past week or two that's going to irrevocably keep me from participating in this program? And the good answer is that that Congress allowed an exemption or a get out of jail free card for situations like this. So should you find yourself in the position that Matt was talking about, that either your FTE count has dropped such that your ratio would not be favorable, or you had to institute salary cuts that were in excess of 25%, for people making less than 100,000, if you find yourself in that situation, as long as you can rectify that deficiency or deficit by June 30th of 2020, then you do not have to go back to that ratio to figure out the portion of loans that would be forgiven. So that the good news there is that with some caveats, there is a way to get back to a complete loan forgiveness, even if in the interim period you weren't necessarily at your FTE level that you were at that baseline period that Matt talked about. So what Matt and I thought we would do is go over a pretty basic example. You can see that what we did is we put together a hypothetical monthly analysis going through February. Now that the act has passed, this will probably go through March, so it'll be April through March for most people. And in our example, we have a pretty simple stagnant payroll cost that's the same every month. So what we do is we list the components of compensation or payroll cost as the Act defines it. And you'll see that it includes things like commissions, tips, vacation pay, retirement benefits, health benefits. And these are all employer paid portions of those. And then the state and local payroll taxes that the employer pays. And we come up with a monthly average and multiply that monthly average by 2.5 times. In our case, our hypothetical company is eligible for an $81,000 loan.
Got it. Thanks, Scott. So if you recall, there's two key tests that determine loan forgiveness. The first one of these was the number of employees test, and we mentioned we're going to step through an example of our understanding and interpretation of the Act. So we wanted to do that here, and just as we've said throughout the presentation, we expect updated guidance from the SBA to further clarify the concepts discussed. So please stay in touch with your lender, attorney, and accountant as this continues to get fleshed out. But we wanted to put up an example of how we think the loan forgiveness tests will work. So the first step in the loan forgiveness number of employees test is to calculate the average full-time equivalent employees during the period the loan is outstanding. So in this simplistic example, it's the number in the red box at the top that is 8. Step 2 is to take the lower of the average full-time equivalent employees from either the period of Feb 15th through June 30th, 2019, or January 1, 2020 through Feb 29, 2020. And those two numbers you can see are at the top of the page. The lower number is the one in the blue box, or the number 10, representing the employees from Feb 15th through June 30th, 2019. And again, that's in the blue box. So step 3 is to perform the calculation, and that's to take the number from step 1, which is 8 in the red box, and you can see it there on the screen, and divide it by step 2, which is 10 employees, and that's the lower of the historical average full-time equivalent employees. That percentage is applied to the amount used for allowable costs. And in this example, we assume that the entire loan amount was used for allowable costs. So we can apply that percentage to the entire loan amount because it was used for allowable costs. That may not be the case in everyone's situation. The result of that number is the amount that is forgivable under the number of employees test. One note, and Scott just mentioned it, there is an exemption, and like Scott says, the Act recognizes that a borrower may have reduced their FTE count between Feb 15th and April 26th, 2020. April 26th, where that comes from, it just happens to be 30 days after the Act was signed. And what the Act says is if the borrower is able to get its June 30th, 2020 full-time equivalent employee count, which is in the green box up there at the top of the screen, to equal or exceed the amount of full-time equivalent employees on Feb 15th, 2020, then the loan is forgiven subject to the salary test. So that is our interpretation of how the rough math would work for the number of employees test. So let's go to the next slide. And so similar here, we're going to take a walk through the salary test as we understand it. And again, expect updated guidance from the SBA to further clarify this. But for step 1, it's for eligible employees, calculate the salaries for the most recent quarter prior to the loan period. And that, in our hypothetical example, is in the second column at the little chart up top. Then do the same thing for the salaries during the period of the loan, which is in the third column of that little chart. Then you calculate the percentage difference between those two numbers. And if the difference is 25% or greater, then the loan forgiveness amount is reduced by the salary difference greater than 25% for those employees. So you can see in our example, there are 2 employees where the reduction is greater than 25%, and that results in a dollar amount of forgiveness between the 2 of them of $1,000. Back to the exemption that Scott talked about. And again, the Act recognizes, hey, a borrower may have reduced salaries between Feb 15th and 30 days after the Act enactment, which is April 26th, April 27th, as compared to the Feb 15th level. The Act says, hey, Mr. Borrower, Mrs. Borrower, if you can get your salaries back up to the Feb 15th, 2020 level by no later than June 30th, then the loan is forgiven from a salary test perspective. You still have to run the test for the number of employees, but there is that exemption that is put into place. All right, and then putting it all together, so we started off with an $81,000 loan, which we used for allowable cost. We conducted 2 tests. One is the number of employees test, and the other one is the salary test. Both of those resulted in reductions of the forgiveness amount. So overall, our loan forgiveness amount dropped from $81,000 to $63,800. And so what does that mean? Essentially, any amounts that are not forgiven but were used for allowable costs will be paid over a term of up to 10 years at a rate not to exceed 4%. And again, remember, if you use 100% of the loan for allowable costs and you meet the two tests, 100% will be forgiven. There is a scenario where amounts that aren't forgiven but were not used for eligible costs, they'll still be repaid over a term of up to 10 years and a rate not to exceed 4% per annum. There is some question about whether if these amounts will require some form of collateralization or not. I think that's one thing that we're watching to understand, but it is unclear. And the other thing I would mention is for amounts that are not forgiven but are be paid out over time, the Act does allow for no shorter than 6 months but not longer than 12 months deferral on those payments. So that's an important point to remember. Again, consult your lender, attorney, accountant, as interpretations of these tests and the impact on loan forgiveness are going to become more clear and over time, and we'll update you as well. With that, I'll turn it back over to Scott.
So at this point, one of the big questions that we have is we know that that Congress passed the Act, and it's going to be administered through the SBA lenders, which are commercial banks authorized to issue loans through the SBA. But what we don't know is kind of the SOP or the procedures that the banks are going to have to follow, as well as the documentation that the banks are going to require right now. And we have up to 30 days to hear about that, but we don't know that right now. So what we're trying to work with clients to say, well, what do we know we're going to need to produce, and what can we be gathering now? And the Act does give us a little bit of guidance as to what they're going to be looking for, and we know that just from talking with some lenders, things that we would expect to be able to provide. So here we have a list of things that we think that our clients are going to need to put together in the interim, so that when they get the go-ahead from the bank saying that they're accepting applications, they can be prepared to process that with their bank. So we know that we're going to need payroll reports for the various time periods. The more granular the payroll report, the better. So, Matt talked about the qualifying cost of, retirement contributions, healthcare benefits, all of it, paid time off, everything that goes into those buckets. So the more granular of a reporting that you have for your employees, the better off that's going to be. Obviously, we'll look at payroll tax filings that have been provided to the IRS. And documentation around all those other payroll costs that we talked about. Going forward, when we look at allowable costs that you're allowed to spend your loan proceeds on, we also know that you're going to need to keep good documentation around the payments of those allowable costs. So mortgage payments, we would need the interest component of that, rent, utility payments, all of those things, keeping documentation, because at the beginning and the end of the loan, a business representative that's authorized on behalf of the business to do this will need to certify that the documents that have been provided are true and correct, and that the amounts requested were used to retain employees and make all these other forgiveness eligible expense payments. So the better the documentation, the better it is, because the Act is clear that the bank will not forgive or will not authorize the forgiveness of the loan without documentation. And so we'll want to be mindful of that as we continue to gather. There are a few miscellaneous items that we wanted to cover before we enter into the Q&A session. There's a provision that's often in disaster loans and other government loan programs that's called the credit elsewhere provision, which says that if you have the ability to access credit elsewhere, like a bank line of credit or something like that, then you'll need to first do that before you approach these government-backed loans. But what's important here is that there is no credit elsewhere provision within this 7A program, and there's also within the CARES Act, it waived that economic incentive disaster loan. It waived the credit elsewhere provision there as well. So you do not have to have been turned down from a bank to access these funds. As we talked about, it has the potential for no personal guarantee and no collateral requirement, which makes the underwriting of these loans a lot easier, and also, the no personal guarantee, no recourse nature of it, provided that is used for allowable purposes, is a really beneficial attribute of this loan program. Any portion of the loan that's not forgiven can be turned out for up to 10 years amortization with a 4% interest rate. So you've got a long payback on anything that's not forgiven. And then kind of an interesting provision for any of our clients that have an existing 7A loan for a business acquisition that's been done that still has payments left on it. One interesting provision in the CARES Act that's not related to paycheck protection is that the SBA will make 6 months of P&I payments on behalf of the borrower straight to the SBA, or to the banks that hold these notes. So this is a really favorable provision for anyone who has an existing 7A loan. So definitely look out for that if you're one of those that has that. Matt's going to talk a little bit about the disaster loan. We didn't talk about it much prior to this because we focus on the Paycheck Protection Program, but there is a little bit of interplay here. So I'll turn it over to Matt to talk a little bit about that.
Got it. Thanks, Scott. And one other portion of the CARES Act that's relevant to the topics we're discussing today are emergency economic injury disaster loans, or EIDL, EIDL grants, not loans. They're a portion of the CARES Act. I'll step relatively quickly through this, but they are a potential source of funds for the folks that are on the webinar. First of all, there's $10 billion appropriated in the program, and it terminates on December 31st of 2020. These grants are $10,000 or less. There is a stipulation that you must be in business beginning on Jan 31st, 2020. One unique piece of this is the applicants approved by credit score. There's another provision that says, or alternative means to determine applicants' ability to pay, which is interesting because the grant is it's a grant, so it's totally forgivable. But the funds can potentially be available in 3 days after receipt of the application for this grant. The Act specifies that the kind of a broad use for the funds: sick leave to employees, maintaining payroll to retain employees, increased costs to obtain materials because of a supply disruption, making rent or mortgage payments, and repaying obligations that can't be met due to revenue losses. So that it's pretty broad. One important note, though, is even though those grants are forgiven, any amounts that are provided under this emergency EIDL program reduce the amount of the loan forgiveness on a paycheck protection loan. But nonetheless, this can be a source, and a relatively quick source, of cash, up to $10,000. So we wanted to call people's attention to that as well. And the last thing we wanted to talk about, we've gotten a lot of questions about SBA disaster loans, specifically the economic injury disaster loan, and how that interplays with the Paycheck Protection Program. And so our understanding is that if a borrower were to qualify for both a disaster loan and a paycheck program loan, they can apply for both, but can't use the funds for the same use, nor use the same expenses to justify the loan amount. An example of that would be payroll costs. This is an important reason why you want to make sure you're talking to your lender, your attorney, and accountant for guidance on how to avoid a situation where you have a duplicative use either for the proceeds or determining the proceeds. Because as we discussed in the Paycheck Protection Program, you're using your average monthly payroll, depending on if you're a seasonal, new, or existing business, to determine the loan amount. So it's important, if you're applying for both, that you avoid this concept of duplicative use, and your advisors will be able to guide you and provide additional insight on that. Scott, I'll kick it back to you.
Yeah, the final thing we had before we turn it over for questions is that we wanted to kind of talk about the toolbox that you should have going into this process. And we think that the key to this application process and understanding it is to really lean on your current banking relationship. Almost every lender that we've talked to that processes SBA loans gives us the response that they will first take care of their existing clients, and then once they have done that, they will be able to process loans for other people. So to the extent that you have an existing banking relationship with a company that with a bank that has an SBA lending arm, even if it's not the person you directly deal with, well, we're advising that you make that connection first. And then if you are unable to get an SBA loan through your current banking relationship, because not all banks have an SBA an SBA approved lender, there is a list of approved lenders that the SBA has, and we'd be more than happy to provide you with that, as well as contacts of SBA lenders that we know and have worked with in the past. And then lastly, kind of wanted to say that the Keiter advisors and really anyone in Keiter can really be a resource to you and get you to the right person if you have questions. Even if it's not internally, we'd be able to point you externally to someone we think that might be able to get you the help that you need. So with that, I want to turn it over to questions. And Matt, I'll kick it off with the question. I would have called it the $1 million question, but it seems to be the $100,000 question, which is, we see reference to compensation around 100,000, and the language is ambiguous such that it's unclear to a lot of people whether or not compensation in excess of 100,000 means that that person's total compensation from $0 is excluded from the calculation, or if only the portion of compensation that exceeds 100,000, meaning we can put that person in for exactly 100,000 and nothing more, whether that's the mechanism. So do you have any insight into that?
Yeah, so Scott, you said it, there's still some ambiguity. More folks that we have communicated with seem to think that it includes salaries of up to 100,000, but excludes the excess. But that being said, it gets back to the true point of there needs to be additional clarification around this and other provisions. But for now, that's what we've heard. But I think it's subject to further confirmation.
Great. One other question that kind of I know we internally discussed a lot, and I'm seeing a lot of the questions in our thing focus around what is compensation to someone who may own a Schedule C business, so they don't actually pay themselves, but they do live off of that business. They have self-employment earnings, but not a traditional paycheck. Or in a partnership setting, a guaranteed payment to an owner. What is some of the commentary around the treatment of those compensation-like expenses that don't necessarily fall on a W-2 or a 1099?
Yeah, and I think specifically to guaranteed payments, what we have heard and believe that guaranteed payments will be included in payroll cost. That effectively it's a form of compensation, whether it's to a sole proprietor, it shouldn't be treated any differently. So therefore, guaranteed payments we believe are included in payroll costs.
Yeah, it definitely says those income that's almost subject to self-employment. So even things that aren't guaranteed payments, but on a Schedule C, you can see how that could qualify. So we expect to see a lot more clarification on that when the SBA comes out with their program guide. But I would say the current thinking is that anything that's subject to that self-employment tax, so guaranteed payments or self-employment earnings should probably qualify.
Yeah. And Scott, looks like we're getting a couple questions around the 500 employee count to qualify, and the Act says 500 employees. Doesn't give a lot of other specificity. So if we look at previous definitions of how the SBA calculates the employee count, it includes full-time, part-time. It does include temporary folks from either a temp agency or a PEO. So those would be included in the calculation to come up with the 500 employees. And if you've been in business and you look at the 12 months prior to the loan, and you literally take the total count of employees as we just defined it, and average that number over all your pay periods during the last 12 months, that's another way that you can verify what's your average employee count. And that's really what we believe you compare to the 500 employee or less qualifier. Scott, anything to add to that?
No. Kind of going under that employee count, there's also a question around attribution or common ownership because, or I think the Act might refer to it as affiliations. And so to the extent that someone might own multiple businesses or multiple businesses are under common ownership, one important thing to realize is that if the Act relies on the SBA's definition of affiliations, which comes out of the Code of Federal Regulations, it isn't a rules-based affiliation system. So, seasoned SBA lenders will probably know of a lot of examples around what affiliations are okay and are not. But it's important to know that SBA considers factors like ownership, common management, previous relationships with or ties to other companies, as well as contractual relationships to determine affiliation. So it's not a simple stock ownership consideration or a vote consideration. So when evaluating these affiliations, if you have ownership across multiple companies, it'd be really important to find someone who's very familiar with the SBA's interpretations around affiliations that can help weigh in on that.
Yeah. Scott, one other question I saw was, hey, what do we need to certify at the time of applying for the loan? And really the Act specifies four things. And, one, it's basically that current economic conditions make necessary the loan request to support the business. Acknowledge that the funds will be used to retain workers, maintain payroll, make mortgage payments, lease payments, and utility payments. The eligible recipient does not have an application pending for a loan under the Act for the same purpose in duplicative amounts. And you also have to certify you haven't received a loan from Feb 15th, 2020 to December 31st, 2020, that you're not going to receive duplicative amounts under a covered loan. So those are really the only certifications that are specified in the Act that we're aware of. And Scott, I think you said there may be some certifications of the data information you're supplying to the lender as well, but that's more uncertain.
Yeah, Matt, one question that's kind of interesting is, if the period, the measurement period for allowable uses is only 8 weeks and your borrowing amount is 2.5 months, can you talk a little bit about how you can foresee being able to still meet the total spend of allowable uses, even though it might appear on the surface that you only have 8 weeks to spend 2.5 months worth of expenses?
Yeah, and again, I think part of this is the 2.5 times is the payroll, but your allowable expenses are broader than the payroll. So the allowable uses will include, like we mentioned, utilities, rent, interest on mortgage obligations, and payroll.
And rent, is something that internally we've talked a lot about, and we've reached out to a lot of resources to understand whether or not related party rent would be an allowable use. And a lot of people are citing other SBA guidance that allows rent payments at market rent as an allowable use of SBA, in SBA settings, but kind of agree that it's not clear that it is or is not allowed. So there's no exception noted right now for related party rent, but we hope to see that more explicitly stated when the program guide is released. So Matt, with that, I think we've hit our time limit. We have about 157 other questions in this chat. So what Matt and I are going to do is go through these questions, and to the extent that you've been able to provide us a name and we're able to match with it, we'll try and get either a response for us or someone from the Keiter team. But also, if you've submitted a question and it's anonymous, and we weren't able to match it, please also reach out to someone who's going to be on the first part of that page, or someone at Keiter that you may know. We'd be more than happy to try and get you that answer. We're going to be circulating this presentation after the fact to all those that attended, so you'll be able to see that, and in that will include Matt and I's contact information. So with that, we thank you for spending your 45 minutes with us this afternoon, and we hope you found it informative, but also we hope that we're able to help you in some way in the near future. So please do not hesitate to reach out if you think we can be of assistance. Thank you.
Thank you.